Hey, this is Dimitri. I'm with the Dimitri team, and we do real estate in Florida. I want to talk to you a minute about a mortgage. So, you're looking at buying a house, you're going to need a mortgage. So, let's talk about what kind of mortgages there are. And I'm just going to touch on three because there are, multiple types of mortgages. But the three primary mortgages that are out there are either a conventional mortgage, an FHA mortgage, or a VA mortgage. So, a conventional mortgage is typically a little bit harder to get than most, not necessarily, but they've got a little bit tighter credit limits and everything else. And then the second is an FHA mortgage, and that is backed by the government. And the FHA is typically you need less money down. They'll take a little less credit score, and they are definitely backed by the government. A lot of lenders like using that because that means that the government is going to pay them if you default by chance. One other thing that an FHA mortgage always has with it is mortgage insurance. No matter what you've put down, they're always going to charge you mortgage insurance for a period of time. That's an additional cost that you're going to have. And a VA mortgage is one you had to qualify. You had to have been a veteran and qualify to be able to get a VA mortgage. And a lot of the VA mortgages are no money down. Not that you can't put money down, but the requirement is that you don't have to have money down. And there's some other benefits for a VA loan as well. Now, all those things you can go over with the mortgage broker who's going to tell you all the specifics of that. The purpose of this is just to kind of tell you what a mortgage is, so you can now go get maybe a little more finer information on that. So let's talk about what a mortgage components that you have in a mortgage. So as I mentioned mortgage insurance, but let's start with the primary mortgage part of the mortgage, and that is principal and interest. So if you borrow $250,000, for instance, you've got a portion of your payment every month is going to pay a little bit towards that principal, and then they're going to pay something towards the interest on borrowing that money every month. In the very first part of the loan, you are paying more towards interest and less towards principal. As principal starts decreasing because you've been paying it over time, then those two numbers start to come closer together and eventually swap, where you are paying more towards principal and less towards interest. But that's probably 12 years, maybe 15 years into the process of the loan. There's a thing called an amortization table, which lays it out every single payment over the period of time that you're going to have the loan, of how much is going to principal, how much is going to interest. The other items in there, if you have mortgage insurance, is a cost going literally to mortgage insurance, which is guaranteeing the lender that you are going to make your payments, and if you don't, they're going to cover the bill for the lender on that. The second is taxes. You're always going to have taxes. This is called an escrow amount, and whatever your property of your house. Now, this is something that gets people by surprise a lot of times, and that is when we look at a house that's listed, taxes might say it's $2,500. You've got to look at on the tax record what that house is valued at. In other words, it's tax assessed at. So let's say it's tax assessed at $150,000, and you're now going to buy it for $250,000. Well, because you're buying it for a higher amount than it's assessed at, that tax is now going to be recalculated based on $250,000, not on $150,000. So that $2,000 tax that you may see on the listing that says, hey, that's what our taxes are today, your actual tax amount may be $3,000, $4,000 because you've increased the property, almost double. All right, so that's another consideration to take, and obviously the lender's going to look at that, and all of this is figuring into your payment. The last is insurance. So on your house, your lender, if you're going to borrow, wants you to have insurance. So if it burns down or a tornado comes and rips it or a hurricane comes, that they are protected as well as you are protected, so that the house can be rebuilt and put back into working condition. So these are all things that are in your payment and consideration for getting a mortgage. I want to switch over here for a second, and I want to show you what just kind of a typical piece. So let's just take a look. Purchase price $250,000. If you put 5% down and you had a 3% interest rate, so that's this first one here. For a 30-year loan, you have a $1,000 payment. Now realize that $1,000 doesn't have mortgage insurance if that's what you're going to be charged, and that's going to depend on the product that you're using and how much money you actually put down. And then it doesn't have your taxes, and it doesn't have your insurance in here. So, but this is a starting point. And what I'd like to show you is what money costs. So for instance, sometimes people worry a great deal about, oh my God, I can't pay $255,000 for a house. I can only pay $250,000. And what I want to show you is that I'm going to change this price to $260,000, and we're going to go. If you notice, it went $1,041. So I'm going to go back to $250,000 and show you. So $41. So $10,000 cost you only $41 a month. So I want you to realize that, because sometimes when you're negotiating a price of a house, you're looking at that big number for the house. Really what you need to start translating that is, what does that affect your monthly payment? Because sometimes it's such a small amount. It's a huge amount when you consider the price of the house, but it's a very small amount when you consider the cost in your monthly fee. One place that I tell people this I think is important to consider is a house that doesn't have hurricane windows compared to a house that does. So you might spend $10, $15, maybe even $20,000 difference in a purchase price. Let's say you paid $20,000 difference. So if you paid $20,000 difference buying the house with the hurricane, you're going to spend $80 more a month in your payment, okay? Because the house went up, you needed, $20,000 more. So you went up $80 in your monthly payment. However, your insurance is going to go from being $5,000 a year down to $3,000, maybe $2,000 a year. So let's just say that you got that $2,000 a year savings. That's $200 a month you just saved on insurance. So you went up $80 in your principal and interest payment, but you went down $200 in your insurance payment, which netted you right there, was that $120. So you actually had a net savings overall on the whole picture by going and buying the more expensive house. So that's something to consider in your calculation when you are considering buying a house, and that's one of the reasons you need to work with a realtor, a professional like myself, to help you get through those decisions and be able to see what is the most beneficial for you. Okay, I hope to see you soon in your next transaction. It's Dimitri with the Dimitri team. Have a great day.